Lessee accounting for finance leases. To illustrate the accounting for a finance lease, assume that, okay, we're going to use these companies. We're going to use the same information for a bunch of examples. So get ready. We are in for a wild ride. So assume that EP Corporation Inc. is a subset of EP Corporation, and Alpha Construction sign a lease agreement dated January 1st, year 10. That calls for EP Corporation to lease a truck to Alpha Construction beginning January 1st, year 10. Please find the terms and provisions. All right, we're going to find everything later on. So this is the information we're going to be using from now on. All right, here we are, lots going on here. Now, the first thing we're going to do is identify what type of lease is this. Is it a finance or operating? Is that going to be important to the question, right? Like to determine the numbers and the math? Not always. I'll tell you straight up, like not always. So it's not important. I mean, it's important to determine who depreciates the asset, right? Because who is the real owner of the asset? Well, then that's going to be important there. But it's a super good practice to identify what type of lease it is, because you'll be asked questions on it, right? A sim could just independently ask you what type of lease is it. It could ask you who depreciates. It could ask you what's the depreciation. Give us some journal entries. What's the lease liability in 3 years? Lots that they could ask for sims. Now, is this the most commonly asked sim? No. But could it be asked as a sim? Yes. All right. EP Corporation Inc. and Alpha Construction sign a lease dated January 1st, year 10 that calls for EP Corporation. Okay, we read that already. Looks like I double included that. Just wanted to give you, it was like the trailer. Now we're watching the movie and you're seeing the scene from the trailer. The terms and provisions of the lease agreement and other pertinent data are as follows. The term of the lease is 5 years. And in terms of determining what type of lease it is, we will see on the next slide. I have it all broken out for you, but if I were you, I would read the information or listen to me give it to you and determine yourself what type of lease is it, so that when we get to the next slide, you've had some practice determining what type of lease it is yourself. The lease is non-cancelable, requiring equal rental payments of $20,711 at the beginning of each year, annuity due basis. Annuity due, we remember we have our present value of $1, which is for lump sums. We have present value of ordinary annuity, which is equal annual payments are made at the end of the year, and annuity due is equal annual payments are made at the beginning of the year. And we know that also because of the beginning of the year right here. And now that's at the beginning of the period, keep in mind. If the lease began, let's say, June 30th, and the first payment was made June 30th, it doesn't have to be fiscal year. It's at the beginning of I just usually say year or period, right? Because it's usually a full year. So that's important because present value factors, right? That's time value of money. It's talking about, your money's worth more today than it is tomorrow or the next day, especially not the next day, right? So if you make the payments at the beginning of the period, has much of a different impact than if it's at the end of the period. The truck has a fair value at the commencement of the lease of $100,000, estimated economic life of 5 years, guaranteed residual value of $5,000. Alpha Construction expects that it is probable that the expected value of the residual value at the end of the lease will be greater than the guaranteed amount of $5,000. So salvage value is $5,000. We expect that the salvage value will actually be greater than $5,000. The lease has no renewal options. The truck reverts to EP Corporation at the termination of the lease. Alpha Construction's incremental borrowing rate is 5% a year. Alpha Construction depreciates on a straight line basis, similar equipment that it owns. So it's basically saying on similar equipment that we own, this is what we do, is straight line, similar to this truck. And EP Corporation sets the annual rental rate to earn a rate of return of 4% per year. Alpha Construction is aware of this rate. This line right here is basically just saying we can eliminate the incremental borrowing rate. We don't need that. That's all that's there for, is if we don't have this. So 4% is going to be what we use. Now we have our criteria to determine what type of lease it is. Last chance for you to do it yourself. I definitely recommend. What are your thoughts? Do it. All right. Well, let's run through our test. Transfer of ownership. Nope, we didn't see anything about transferring ownership. Purchase option. Nope. We are not reasonably certain to exercise it. However, the lease term was for 5 years, if you noticed, and the economic life of the truck is 5 years. So yeah, that's 100%. 100% there. And same thing, 100%, present value was $100,000 and fair market value is $100,000. So that meets that criteria. Over 90%, over 75%. These both happen to be 100%. Not always going to be the case, just is. Alternate use test, the asset is returned to EP Corp, the original owner, with some residual value. So it does not meet the alternate use test. Meets two of the tests. Remember, it only needs to meet one of these to be a finance lease. So it's a finance lease, and as such, we're diving into accounting for finance leases. It's a great time to get into it. We're gonna run through many examples, many journal entries, questions. Take a stretch now, buckle up, get ready. We're gonna have a fun time. Okay. First off, I'd say let's determine the present value of the lease payment. So the question might ask you, just one question just might straight up say, what is the present value of the lease payments? What's our current liability? Well, we're paying payments of $20,711. We are paying for 5 years. Now, this present value factor would have to be given to you. We're using our 4% because that is going to be 4%, the one that's the implicit rate. Now, if they really get into it, they'd say present value factor of annuity due, which is what we're using, right? Again, this is me writing the question. I didn't include that here. It's fine. There's only one option to choose from. But N, if you haven't seen this before, N is like the standard for periods, I, interest rate. So N is 5 periods. Keep in mind that it's periods, right? Because if it's semi-annual, then this would be 10. And this would be half, right? Because it would be for half the period. So present value factor is given. Now, present value of lease payments is $95,000. Let's just take a look at this. I always like to make a point here. Your money's worth more today than it is tomorrow, right? That's the whole concept of present value. So if we just took $20,711 and multiplied it by 5, which is the life of the lease, the value of this here would be about $103,555. What it's saying is the present value of all of this is $95,000. So essentially, you, by leasing, are saving a good chunk of change, in theory, because of time value of money, by leasing, right? That's what this is saying. It's saying over the course of the life of the lease, you're paying value of $95,000. You're really paying $103,000 because that's a simple calculation, but your money is worth more today, and you're not giving it up today because you can give it up later in the years that you're leasing it. I always like to drill that down. That is something that confuses the heck out of people. It confused the heck out of me. I'm never going to pass that up without explaining it again. EP Corporation uses Alpha Construction's implicit rate, right, instead of the incremental borrowing rate because it is known. Now we get into some journal entries. Here we go. Journal entries all the way. Well, what happens? Think of this this is a similar journal entry, right? So the finance lease on its books. What would be the journal entry if we bought a truck for $95,000? I'm just going to use clean numbers. Well, we would debit truck, which is an asset for $95,000. And if we didn't use cash, we would credit accounts payable for $95,000. So this journal entry is really no different. It's debiting an asset, which you're getting, crediting a liability, which you're having to owe, right? And we do the present value of it. That's what it is on our books. We just did that present value factor calculation. And we'll do our first lease payment. It's annuity due, as it mentioned. So payments are made at the beginning of the period. Beginning of the period is January 1st, year 10. That means we owe a payment the first day. If it's ordinary annuity, it would be 12/31, year 10. It would be at the end of the year. Now, we reduce our lease liability by $20,711, and we credit cash. Now, keep in mind, there's no interest. We didn't deal with interest because not a single day has passed, and interest only accrues as time goes on, like we saw in bonds. So see here, if this was 2 days later, we would also include interest expense and deal with that. But lots of tricks. You'll see these trick you in the exam. Definitely something to watch out for, but I have confidence in you. Practice. You will be fine. And just reiterating on the right of use asset over here. So remember, this is going to represent the lessee's authority to utilize that leased item, right? You have the authority, the right to use it. So it's typically property or equipment over the duration of the agreed upon lease term. In other words, you're granted the right to obtain the economic benefit from the usage of the asset owned by the other entity. That's right of use asset. Get familiar with the term. We're going to see this in leases. Lots of journal entries, lots of good practice. Now we have our lease amortization schedule. Remember, we're dealing with annuity due here, so the payments are made at the beginning of the period. In this case, it's the full year. It's 1/1. That's what we're dealing with. And questions might have you just simply answer, well, what's the lease liability at the end of the second year, third year, or what's the interest payment? They might give you components of this, but just like bond amortization or depreciation schedules, it's really important to see the whole process drawn out. Now, at the end of the 5-year period, obviously you've got no lease liability left, right? You're decreasing that throughout the whole process. You've got the present value at the end of the period is that present value you calculated. That's the total reduction of the lease liability. Your total interest here seems to be $7,665, and your total annual lease payments equal $103,000 about with these $20,711 payments. Right, so you see here annuity due. So at the beginning of the lease, no time has passed, so there's no interest being dealt with. So you just simply pay it down, right? And then you start making payments, and you calculate 4% of the remaining balance. So 4% on 95, 4% on 75, and that's how you get your interest payments. You take that from your lease payment, and that's what you get in terms of your reduction of lease liability. Just like when you're paying down a mortgage, this is the same thing as a mortgage pay down schedule. Now here we're going to record our first journal entry, right? So we've got our numbers, which is super important because questions will ask about your numbers. But what are your journal entries? Questions could also ask for your journal entries. Now, what's the journal entry to record accrued interest at December 31st, year 10? Let's think about where that is. That is the day right before this day, and it's the end of this year. So it's one day before 1/1/11. Let's think about that. The interest is paid annually. So over the course of year 10, we have been accruing this interest. We have interest expense now of $3,007, and we have accrued interest of $3,007, which will immediately be paid off the next day on 1/1/11, right? But we are now reporting this. And you might remember from bonds, remember, interest expenses on the income statement, that's going to go up over the course of time, right? It just goes up and up and up. However, accrued interest, right? It goes up and then you pay it down. So it goes to zero. It goes up and then you pay it down to zero. It goes up, you pay it down to zero, just like your credit card, right? So interest expense, you could think of this like your total credit card expense, your total spending over the course of, whatever, a year or 5 years. But your balance on your credit card goes up and you pay it down, hopefully, right? It goes up and you pay it down. That is something I want you to keep in mind as you're seeing all of these examples and bonds and leases, the difference between interest expense and accrued interest. Also, lease liability, basically it's a liability, right? Accrued interest is a liability. Lease liability is a liability, obviously. Are they going to really nitpick about which account they want you to use? No, it's going to be pretty clear which they want you to use. But both of these are a possibility in terms of the name you would have to use. Now, let's deal with another journal entry. Well, we are still at that same period, right? The same date, December 31st, year 10. We're recording the amortization of the right of use asset. Now, we are amortizing the right of use asset. We are applying Alpha Construction's depreciation policy, which we know is straight line. Well, we have the life of the asset, right? Both the life of the asset and the life of the lease was 5 years. Present value of the asset is our $95,000 amount. We are going to do this journal entry 5 times each during the course of each beginning period, right? Or sorry, at the end of each period. So December 31st of each period, we are this is essentially depreciating, right? Depreciation expense and accumulated, right? Similar process here, but we're just amortizing. So amortization expense for 19,178, and we decrease the asset of right of use asset by the same amount. Now let's check in at our balance sheet at the end of the first year. The first year is year 10. This is December 31st, the end of the first year. What are we displaying on our balance sheet and our income statement, right? It's nice to see this here to kind of explain what's going on. Well, first we're going to start with our non-current or long-term assets. Well, what is that? That's our right of use asset. We started with our present value balance of $95,000. However, as we saw in that journal entry we just made, we reduced it by 1 period's worth of amortization expense. So that simply gives us a remaining asset of $76,712. Cool, makes sense. Pretty straightforward there. Now for our current liability, Well, that is going to be, you could either calculate that. I mean, I would just take it from what you are going to pay in the next year. And remember, current liability is what you're paying within 1 year. What are you paying? You're paying $20,711 each year, so that's your current liability. Doesn't matter what portion is principal and interest. This is just breaking out that this is the interest and this is the principal portion. So that's your current liability. Now, how about your long-term liability? What's remaining? Let's take a look at that. Let's go back to our chart. And here we see, okay, we are now at the end of year 10. So essentially we're at 1/1/11, right? We're at 10/31/10, right? Or sorry, 12/31/10. But we have the all of year 11 is now current. So that means 12, 13, and 14 is long-term because this is what's remaining. So we're going to take this $57,000 amount, and that's going to be what we have to pay in the future past 1 year from now. That's our long-term liability. And thus, here is our lease liability. So this is what is displayed on the balance sheet in regard to our lease. Let's cover the income statement amounts, which will be interest expense. Well, what have we accounted for so far? It's just that $3,000. And amortization expense, right? Just like depreciation expense, expenses go on the income statement. Nothing too wild, nothing too crazy. I hope you're staying with me, right? We're having a good time. This is not too tricky, not too difficult. This is the whole process. And questions you'll see will dive into one smaller part of this, right? Multiple choice questions will ask you one small part of it, but if you understand the process as a whole, that will significantly improve your odds for those questions. Now, what is the entry on 1/1/11? So we went from 12/31/10. Now we're actually on this date. Well, here's our second lease payment, right? The second lease payment happens on 1/1/11. It's the beginning of the year. And now we are reducing that liability, right? So remember, I was showing you this graphic, you pay it down. Now we're at this part where you paid it down to zero. So you reduce your liability because before we credited our liability, now we're debiting our liability because we paid it down in cash. That's all that's happening, right? All that's happening. Interest expense overall for this life of this lease is still up, but the balance sheet account is now at zero. Awesome. Still have the same numbers, right? These aren't going to change. This is our schedule. Let's keep rolling. All right. So, yep, I would say that is a good taste as to what you're going to have for your journal entries, for your accounting for finance leases. I'll call them finance or financing leases. I mean, the official term is finance lease, but I call them financing leases because you are essentially financing something. We're going to see this plenty of times, many questions on it. You're going to keep repeating these journal entries until you get to zero. If I were you, try it all out. Try it all out and practice every journal entry until you get to that zero lease liability. Great job so far. Now, if EP Corporation purchased the equipment from Alpha Construction at the termination of the lease at a price of $5,000 and the estimated remaining life of the equipment is 2 years, it makes the following entry. Now, this was the salvage value, the possibly purchased option there. This would be the journal entry, right? Just if you're purchasing the equipment, that nothing crazy here, right? Just if you're purchasing the equipment, this is what you would do regardless of leases. If you were you would debit equipment, debit your asset of equipment for $5,000, credit cash for $5,000.